Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Don, sometimes the show just writes itself. Sometimes, folks,
Tell me.
listen, I've been doing this. I came up with this kind of new idea to kind of explain how Wall Street exploits the retail investors, how they exploit them all the time. And I came up with this pie charts are us, and we've trademarked that. Pie charts are us, how Wall Street takes your money, right? And they spread it around all of their clients, the emerging markets, the international, the blue chip, the muni bonds, the corporate, the treasuries. Those are their clients. And now they even have the illiquid investments, the ETF wrappers for the private equity and that private debt. What could go wrong there when we have an illiquidity crisis? Anyway, I've been raging against the machine. I've been railing against all these conflicts of interest and these lie charts where diversification is no help. About every 5 years when we have a bear market, it's no help. And so I kind of got tired of that. So I was going to move on, but then all of a sudden I think they're listening. I think Wall Street's listening because in the mailbag, I always put a few articles in the mailbag so that you can see what we see as advisors. And there's an article, Edward Jones seeks to shed its cookie cutter image. Folks, you know what cookie cutter image is short for, right? Cookie cutter is pie charts. Pie charts are cookie cutter, pie charts. Okay, now, Edward Jones is not going to change their strategy, their cookie cutter strategy. They're just going to change their image. So we're just going to put a little bit better lipstick on the pig. Folks, if it was working out and they were making money, nobody would care. The clients wouldn't be upset. They wouldn't have to change the image. They're changing the image because the outcome is not good. Otherwise, you've heard the old adage, if it ain't broke, don't fix it. Anyway, that's why we don't Don calls it all the time, diversification, right? You don't go to the store and you don't buy rotten fruit to have a balanced diet. You only pick the freshest stuff. We only want to have some of the best sectors and the best stocks. You don't want to have the bad stocks or the worst sectors. We've been talking about it for years that emerging markets and international has been in trash. You shouldn't own it. Why would you own stuff that's going down? That has actually changed significantly just in the last few weeks, month. So now would you make a big allocation change? Or do you just stay with that cookie cutter approach? All right. Now, when things are going up, I want just enough diversification so one Enron or some company cheating doesn't cream my portfolio. So I want to manage my position sizes and not have one too big monster position that'll cream me. But on the way down, the correlations all grow together. It all goes down together. I don't want diversification. I want cash or maybe just gold and cash or just a few things. So right now, we're very, very heavy in cash. Okay. So there's another article in the mailbag and it says, the world is changing. U.S. stocks no longer lead. Did your advisor get the memo? Did you change any asset allocation or do you still have that same exact pie chart you had last month? And you're just waiting for that special arbitrary rebalancing date that comes once or twice a year. I've got a question. Does that arbitrary rebalancing date, is that going to be the perfect right time? Or is it just really random and you're just going to get lucky or slaughtered? In other words, do you rebalance after the market went way down? You wrote it down and then you rebalanced? That doesn't help. In any event, lastly, there's an article. It's a Harry Dent crash alert. He does this every 6 months trying to get attention. He's a great economist. He's a lousy money manager. He opened up some ETFs and they had to shut him after 2 years because he did so bad. But he puts out this clickbait. Look, folks, there's people that are talking about don't miss the next monster rally. They're perma bulls and they're perma bears. Harry Dent's a perma bear. The sky's always falling. Both those allocations will get you slaughtered at some times. Price is truth. That's how we manage money at Revere. Okay? But anyway, so I got a bunch of mailbags, and look, we have clients that send us or listeners that send us articles, whether it's a topic or a stock they want talked about. And I got some things about the SALT taxes and some new stuff coming in Congress for taxes and planning in the state. And folks, if you did all that, I mean, if you have any questions on that, reach out and call me. We do the whole holistic planning. But right now, people are worried about the market, so I don't really want to go into that other stuff and drive. I do want to hit one real quick. This one client, he sent it to, or one listener sent it to me today, KP, Dan, I think you recommended this book, Creature from Jekyll Island. Wow. It opened my eyes to a number of things. Thanks. Me, pretty scary. Do you know, I don't know if you got to the back of the book yet where it talks about the IMF and the World Bank. The first half is about the Fed. The IMF and the World Bank, it literally causes mass starvation and famine all over the world. Folks, if you haven't read that book, it's pretty heavy reading. You ought to read it. Anyway, all the other tax planning stuff, those are from clients that are already safe and secure because they've got a huge cash position. They're not worried about what's going on in the market. But we got a lot of listeners that aren't clients that are scared to death right now. So I don't really want to do the mailbag stuff. If you've got questions about planning or taxes, call me. We do all that. We can help you with any of that planning. But with that, I want to go to Don and I want to find out what price is telling us and what truth is telling us. So we want to know how the allocations would be here at Revere. By the way, if you want your money, folks, that's why I called this show Your Money. Because it's your money, it's not Wall Street's money. Wall Street thinks it's their money. They take your money and they make it their money, and you're the diversifier for their real clients across all their portfolios, their muni bonds, their emerging markets, their growth stocks, their treasury bonds. You're the portfolio input. You're not the client, you're the product. So learn a better way to invest. By the way, those are all conflicts of interest. That's the sell side. They're selling you stuff. We represent the buy side, the fiduciary, okay? If you ask them at Fidelity, even Schwab, Merrill Lynch, Morgan Stanley, do you represent me or do you represent your firm? By their license, they've got to say, I'm a registered representative of XYZ. At Revere, we put the clients first. We only represent you first. And by the way, my portfolio looks just like yours. If you're in Grotection, my portion that's in Grotection, I also have TurboTection. My portion that's in Grotection has the exact same timestamp and price as you do, as my 92-year-old mother, as Don and his family. Our family money is all in these strategies. We put our money where we're not that CNBC guy that says, this stock's the greatest thing since sliced spread. I don't own it. My wife doesn't own it. My company doesn't own it, but you should. That's because their client is the company and you're the product and you're getting sold and you don't know it. So learn a better way. Learn how to manage your money like real professionals and come join the Revere family. Anyway, Don, so what's going on in the markets? What is price telling us?
Price is telling us to be very careful, which we've been detailing for weeks on our videos and podcasts. But really what we're looking at, let me step back to 2 Fridays ago. The S&P 500 was falling fairly quickly, broke the 200-day moving average. 2 Fridays ago on the 3-7, we had an undercut and reclaim of the 200-day moving average. That's a significant level. We talk about it all the time. That's the spot that all bear markets historically cannot occur above the 200-day moving average because by the time you get to 20% off of the highs, you're always below this key level. So for us, just math. So to us, this is always the dividing line between a healthy market and a risky market. And we're certainly in a risky market situation right now because the Monday after that supposed goal line stand, the undercut and reclaim of the 200-day moving average, we had a nasty gap down 2.7% on the S&P 500. And it started this 2-week consolidation that we're in between 5,700 and 5,500. If you go to a 30-minute chart, you can see it more clearly here. Here's the undercut and reclaim. And then the next day was the gap down. And ever since then, for 2 weeks now, we've been trading in this tight range. we get to the top of the range, the bulls get hope, we get rejected. We haven't been to the bottom of the range in over a week. So really, there's two ranges within this level. They're both 100-point ranges. The market gravitates to these round numbers. It just does. The S&P 500.
Human behavior. It's human behavior.
Yeah. So, well, the machines kick in because they're programmed by humans.
Right.
But we bounced. So this morning, the bears had a chance to blow this wide open. We had a gap down of about 1% at the open, and buyers came in within the first hour. We traded tightly. We tried to move higher, but we've been fading since then. But this 5,600 level is key. The low from 2 days ago, 55.98 to be more precise. That opens up another 1.3, 1.4% drop down to the 5,500 level. And I've also been talking about kind of a 3% envelope in here for some past studies of when we break the S&P, break the 200-day moving average. Sometimes you bounce around for a short period of time and then reclaim it. Bulls are putting up a fight, but the bears are putting up a fight as well. We just had FOMC on Wednesday. It was initially seen as dovish. We rallied on Wednesday, but closed weak. Thursday, we tried to rally and faded. Today, we dumped at the open, tried to rally, and that's fading again too. We're actually trading at 56.18 as I speak right now. So what we're seeing is the NASDAQ 100, the big cap names that have driven this most of this rally that started in November of 2023, they peaked over 3 months ago, and from a relative standpoint have been continuing to make lower highs and lower lows. And that's what's dragging down the S&P 500. The equal weighted S&P 500 RSP looks better. It tried several times to reclaim the 200-day moving average over the last week. Gap down today along with the market. But what you're seeing is a lot of these bear flags breaking today. And the S&P 500, the RSP, they're all over the place. I drew these trend lines last night in Thursday night's video. A lot of them are breaking. That's obviously a bearish sign. So what are we doing in-house? Well, we've got 4 starter positions, and we've had mixed results with them. Some are down a couple percent, some of them are up a couple percent, but we are seeing about a dozen stocks that are showing clear relative strength, but the weight of the market is keeping them from making any significant progress. And our stops are tight. We've got very little risk in the market. It's a combination of gold, silver, long index, taking keeping in mind this 3% range below the 200-day moving average, and 4 individual names that are, like I said, we're seeing mixed results with them. But breaking 5,600 is a big negative. Breaking 5,500 will get us out of that 3% envelope and really increases the risk to the downside. So the line in the sand is 5,500, and that there's an event coming up in 2 weeks. April 2nd is Tariff Day. There's a lot of negotiations going on behind the scenes with various countries, and the plan is to institute reciprocal tariffs. The cabinet, specifically Lutnick and Bessent, Scott Bessent, Wall Street really likes him. He's a long Wall Street veteran who is providing a lot of common sense, and he's been very vocal, doing the rounds of talk shows and stuff, explaining the situation that we're in. We also have $7 trillion of bonds that we have to refinance over the next 3 months, and that's one of the reasons they're focusing on getting the 10-year interest rate
down
lower as possible. Yeah. So to reduce interest rates because of that refinancing. But Howard, and then Howard Howard, why am I freeze on his last name? Not Luck.
Lutnick.
Lutnick. Yeah, Howard Lutnick. Geez, I can see his face in my mind. Howard Lutnick has been also very vocal. He's the Secretary of Commerce explaining what we're trying to do. And they've been very clear that there's going to be some short-term pain in this. So there's no optimism for the market from the administration right now. Trump regularly talked up the stock market during his first term, pointing out how well it was doing as a reflection of his policies. But they're pretty much uh, trying to dodge a recession, register some sort of a soft landing as a transition from really an economy that's been government focused to one that's more private focused, by raising tariffs to lowering taxes. And is it going to work? The market hates uncertainty, and we're in a very big uncertain period right now. But that said, the bulls are putting up a fight. The bears are equally as strong. The recent areas of strength, you mentioned the rotten fruits and vegetables. Right now, the U.S. is the rotten vegetable. Let me bring up a couple charts. FEZ is a Euro Stocks 50. This has been showing massive relative strength against U.S. stocks for the first 3 months of the year. It's pulling back right now to the 21-day moving average. China, FXI, I'll show as a ticker for that. Also, strongly outperforming the S&P. It's pulled back to the 21-day moving average right now. So that script has kind of flipped. And though the PE, the forward PE on Europe specifically, but also emerging markets, is not as high as it is on the U.S. U.S. was really priced for perfection going forward, and uncertainty completely removes that priced for perfection scenario. And that's been reflected in prices very clearly. Like I said, tech's been leading on the way down. This 5,500 is a key level. We've got type stocks. We have less than a 2.5% downside before we would get stopped out on everything that we own. And we're taking it day by day. The bulls are putting up a fight. I mentioned April 2nd with the tariffs. That's an unknown right now. How many of them are there's negotiations going on trying to get other countries to lower their tariffs or get them to realize that we're putting on reciprocal tariffs, and if they raise theirs in response to what we do, we're just going to raise ours
Right.
to match what
Right.
tariffing our product on. So
Right.
that's a big unknown. In theory, it's going to bring in a lot of revenue for the government, but it also threatens to slow profits. It's inflationary because you're raising the prices, excuse me, of goods.
Well, here's the other
So,
here's the
yeah,
other un- here's the other
all
unknown that's,
uncertain.
here's the other unknown that's kind of that people don't are uncertain about. So a lot of these multinationals, folks, a lot of these big mega corporations, they've got manufacturing plants in Europe, Asia, and United States. They can just adjust their factory orders. So a lot of this onshoring, so a lot of manufacturing is now coming back to the United States. Trump has actually been able to bring back manufacturing. That's because these companies are worried about paying big tariffs. So instead of paying big tariffs, they just move the manufacturing to the U.S. Problem solved, no tariffs. They avoid the tariff. But that also can have other effects because like UPS, like global. So now that would mean you have less global trade. UPS got hit today pretty hard. Was it UPS, Don, or FedEx? UPS, right?
FedEx. It was FedEx.
FedEx. So that can have. You're going to have dislocations. That's another reason why the way that we manage money, price is truth, works better than just throwing everything at the wall and seeing what sticks. Because a lot of stuff is not going to work out well. Why do you want stuff that doesn't? Why do you keep holding stuff that doesn't work out? We always say it's okay to be wrong. It's not okay to stay wrong. If Don buys something and then it doesn't work, we'll quickly sell it. In fact, what's funny, what people don't realize, when you buy a stock, you'll know within a day, you'll know very quickly whether it's going to work out or not. So actually the losers get sold normally very quickly within a day or two. It's the winners that actually you hold and they run. Anyway, sorry, go ahead, Don.
No, that's a good color on that, Dan. So, I mean, basically, the risk with us being below the 200-day moving average, the risk is very clearly to the downside, and we've been reflecting that in our portfolio allocations since 221 when we broke the 21-day moving average, and that was a week where a lot of leading stocks just started getting sold hand over fist, and that has continued to the last couple of weeks. It's moderated a bit. Some are completely broken down. Some are leaders and are above the 21-day moving average. We've got a decent list of about 50 stocks that are above the 21-day moving average. And like I said, about a dozen we're really focused on. So we'll take it one day at a time. We'll continue to provide in detail in our videos what we're planning on doing and what our interpretations are. I showed this, what does it take really to make a bottom? I showed this on Monday's video when we reclaimed the 8-day moving average, and I marked it off. But there's really a lot of work for the bulls to do for this to be what we would call a truly bullish environment where price is above the 8-day, 21-day, 50-day, and 200-day moving average. On 317, this failed the next day, 318. We got back above it on 319. Today on 321, we're failing back below it again. So as of right now, none of these steps, and this is from an S&P 500 index perspective, none of these steps you can check off. Below all of them. So,
and let me mention one thing. I want to keep that, you minimize that thing and show the chart, show the stock chart. So folks, here's the bottom line. Don's talking about these layers. So that 200, that black line, that 200 is the big long-term line in the sand. The big institutional money starts taking money off the table, and they got to manage around. So when we hit the 200, folks, Revere is we've already got a big cash position, probably 50% or so. I'll let Don explain exactly.
Yeah, it's over 50.
Yeah, so we've already got a big, and then if it breaks below that, we could even go flat or even net short if it got ugly enough. But we first start taking a layer off when we break the 21 exponential day. Then there's another layer at the 50 day, because you can't just you can't just move in and out. Then you're day trading, it's way too hard. So you got to do it in layers based on what it means. Now, folks, here's another thing you need to understand. Just because the market is risky doesn't mean it won't go up. So right now, the market's showing you got a 6 and the dealer's got an ace. Doesn't mean you won't win that hand. It just means you play that over and over. So right now, we've got a little bit of exposure, but we are certainly not all in because this is dangerous. If the market holds and starts going up and starts reclaiming some of those levels like Don talked about, he will mechanically add layers in. If it breaks down, we will get sold out and go flat. That is why price is truth, and it doesn't matter what we think. It doesn't matter what Don thinks. It doesn't matter what I think. We're getting our emotions out of the way, and we're doing it. And so I got to ask you, is your advisor being this meticulous, or is he saying stay the course, the market always comes back? That's a tough way to manage money, man. Anyway, go ahead, Don. What do the guys got?
Let's go over to Todd first. He's going to talk about some of these names that are holding up very well. Take it away, Todd.
All right. Well, as crazy as it sounds, we are on follow-through day watch, and all bull markets start with a follow-through day. But not all follow-through days lead to a new bull market. There are oftentimes many failures. But as part of that follow-through day process, it's our job to continually keep a watch list of stocks that are displaying good relative strength, holding up in bases, or, just showing new products, services, whatever it may be. And the first stock I want to talk about that is holding up relatively well is Take-Two Interactive. And I have a little story about this. Earlier this week, my son and I were watching some March Madness basketball, and my son asked me, he said, "Dad, who owns Monster?" And I said, I think Pepsi owns Monster. He goes, "Oh, that's kind of crazy." So finally, later on in the conversation, it dawned on me he was talking about video games, and the company that makes Grand Theft Auto is Monster Gaming, and Take-Two Interactive owns Monster Gaming. And I started talking to my son about it, and he said, this is probably one of the biggest things happening in gaming right now. The last time Grand Theft Auto came out was in 2013 when he was in 8th grade. Now he's 25 years old, and he's not a huge gamer or anything like that, but this is a big buzz happening right now. So Take-Two has about 5 or 6 new games coming out this year, most of them toward the end of the year. And Grand Theft Auto is one of the biggest games, and this particular release is expected to potentially be one of the biggest entertainment launches in history. So they're expecting about 1 billion in pre-orders, and they're expecting this game to do an additional 3 billion the first year. So typically, I like to see stocks that have at least an 85 composite rating or higher. This particular one has a 74 composite rating, but it's because the company hasn't had any new releases and they've been developing new games, and all these are expected to hit this year. So they're just finishing off right now fiscal 2025, and you can see on the data box that it's expected to be down 1%. But 2026, which starts in April of this year, they're expected to do 200% increase in earnings, and this is a result of all these new launches. So sorry for the long-winded explanation on what's happening with this company, but this is a 2026 on story. And the new version of Grand Theft Auto is supposed to have a lot of new features which allow for new monetization strategies where, you know, they can do all types of transactions and different things. But regardless, looking at the chart and getting down to business, you can see huge earnings gap up on the last earnings report that Don shows here with the red hash. You've got a pretty solid situation where the stock has basically been trading above its earnings gap throughout this whole recent consolidation. And the last week here, it's been pushing and trading close to its highs. So this is just a very bullish situation. There hasn't been much volume on it, but relative to the market, this is holding up very well. And this is the story with what's happening with this stock. So this is on, our watch list. The second stock I wanted to talk about is OKTA. And interestingly, I saw when Don was talking about the market, he had an OKTA alert going off on Market Surge. So OKTA is a security company, but they're known primarily as a leader in the identity and access management end of security. And one of the things they offer is single sign-on. So if you're a large organization, you can sign on to multiple applications with one sign-in. They're also into multi-factor authentication. But some of the highlights of OKTA here recently, you can see this stock has been in this kind of big choppy base where last year or earlier this year, you had this big gap up. Let me just pull up the weekly chart. So you've got this big stage one base on the weekly here, and it's about 38% deep. Starting this base, you had a big earnings gap in the spring of 2024. The stock tried to gain progress, but failed and went into this big base. Had a couple of earnings reports where it gapped down and built the lower end of the base. And then in the latest report, it gapped up on a very strong report, and it's pushing the highs of this big stage one base. And this is standing out as a potential change in character for this stock. I personally tried this stock back in the March 2024 gap up. Stock failed, and it just couldn't gain any steam. But overall, they saw a 22% increase in customers with annual contract values exceeding 1 million, bringing that to a total of 470 customers. And 70% of their quarter four transactions were influenced by partners. So they have a strong enhanced partner ecosystem. So like Amazon Web Service, and
Yeah,
large,
B2B,
yeah, B2B will come in and, and sell Okta's authentication, yeah, security software within those packages. So 70% of those quarter four transactions were influenced by those partners. And that seems to be what's causing this stock to act pretty strong. So we're watching this.
So do you think is that a bear flag? A bull flag? Is that a well-developed bull flag, or is that?
This, I would say this is somewhat of a bull flag. What would you say, Don?
Yeah, definitely.
Okay.
Yeah.
Pull back near highs on lower volume forming. Yeah, looks great. It's the market is holding this stock back.
Right.
Yeah.
And I'm going to talk about that in a little bit, but keep going. Yeah.
Yeah. So we may or may not, put on a pilot position depending on how the market acts, or this could be a candidate for a follow-through day ad. And just real quick, not going to go through these charts in any detail, but a couple stocks that have also been displaying strong relative strength. One is Spotify. Quick reclaim of its 50-day moving average after it, fell pretty hard below during, the market correction we've been in. But we're looking for this as a sign of strength. If a stock can quickly reclaim its 50-day moving average, and Spotify is one of them. And another one is DoorDash. And this is another one that fell below the 50-day, but also was able to reclaim the 50-day moving average with relative strength, moving up here recently and hanging in the 95 area. So those were the four stocks I wanted to highlight as potential follow-through day candidates. Oh, and there's Uber.
Yeah, there's another one that we're watching that just popped up.
And folks, that you just saw that in real time, how our alerts come up. That's how we're managing money in real time. And then you got these Ray J's and Ed Jones that you got a pie chart.
Uber WGS is another one that's a biotech stock that's holding up very well. And here's Spotify back above 600. This is how it works in real time.
This is how. And by the way, folks, so here's just to pull the curtain back a little bit. So these guys are always analyzing the stocks because the market's getting hit pretty well and it's down. Most stocks are down. So when the market goes down, 75 to 80% of all stocks go down. And likewise, when they all go up. So even though they're finding some of these stocks, they're not taking positions in all these stocks because the market, it will pull down those stocks. That's a higher risk entry. It doesn't mean you won't make money. It means you got a 6, the dealer's got an ace. You can win that hand, but you don't want to play that every time. So what Todd is saying is he's got 3 or 4 stocks that he's bird dogging, that he may take a starter position, see how it works out, or he's ready to go for when the market does start to rally. These stocks are going to go for, these are most likely highest probability to be the leading stocks. So you got to manage overall market strength and then see what you're going to, and then which areas, and then depending on the total breadth will help determine how much you have totally invested. So Don, like what would you say our beta is right now, Don?
It's 0.6. All these alerts are going on. These move with the market. The market has had about a little 0.5% rally while we've been talking here. And This is a 1-minute chart of the SPY. You can see it going off. And we always this is my market surge. I always keep bracket alerts, one to the upside, one to a key downside level, to be able to keep my finger on the pulse of exactly what's going on with the individual names that we're watching, because you can either, in a normal market, we could buy strength. In a market like we're in now, we prefer to buy on a pullback to a very low risk entry with a moving average. So support. You can see, so bracket alerts that we keep on all of our names.
Yep.
Good stuff, Todd. Ted's going to take control of the screen, and he's going to show a trick that makes bearish charts look bullish. Take it away, Ted.
Yeah, so thank you, Don. I just want to share quickly, this will be a relatively short segment compared to previous ones I've given in the past. But just a quick tactic I will use, especially when we are in a period of more heightened uncertainty. We are typically a primarily long firm, and I also primarily trade on the long side, but I will start shorting some stocks when the longer term trend of a market, a sector, or a stock is hinting at a potential longer term downtrend. And since I'm more conditioned to look at the long side of the markets, I do use a trick when I do see a chart that is starting to look bearish on deep view and in trading view, which is what we're using now. You can't do this on market surge, unfortunately, but if you do on the Mac options I, or I believe on Windows Alt I, it flips the chart over completely 180 degrees.
So let
Essentially,
me put on my TED interpreter. So what he's saying, well, like on Thinkorswim, if you put a negative in front of the ticker, it flips the chart up so that it reverses it. So if it's a bearish chart that looks down and you're used to looking at bullish charts on the upside, it flips it. So if it's a bullish upside, in other words, it shows you can read a bullish shorting chart that goes up. It makes it, because you're used to using long charts. It makes a short chart look a long chart.
Exactly. And to me, why this is extremely useful, it can really keep you out of false breakdowns in times where perhaps the market's pulling back and, naturally human emotions, you start to feel some fear and you just end up buying that exact low. So flipping the chart over, for me at least, gives me better clarity on whether it is a viable short step or not. So I just want to go through the semiconductors ETF, SOX, and go just over this last bull market real quick. If you remember, we had this 3-month pullback or correction in around September 2023 through August. And since this is an inverted chart, it's actually a rally. When you see this rally, and then you see the long-term 150-day and 200-day still in downtrends, that's a great clue that this is likely not going to continue much further. As you can see, we did shoot over the 200-day moving average, a declining 200-day, and then we came back in. So on the regular chart, we pretty much undercut and reclaimed the 200, and we start this bull market. Then, continuing on to 2024, we had some sharp pullbacks like this one, but didn't even get to the declining 150 or 200. In the summer, when we had the Yang trade scare, we had the sharp pullback in the SOX index, and since it's inverted, just get that in your head, because it could get a little confusing based off my commentary. This had a huge move to the upside, so on a regular chart to the downside, and once again, it had a declining 150 and 200-day moving average. So that can kind of tell you and give you a hint that this probably isn't ready for a longer term downtrend. However, then the semiconductors ETF has been basing sideways for 3 to 4 months. And if you remember, I've given stage analysis overviews on the podcast multiple times. When we look at the stage 1 basing period, this is exactly what we have. A stock, a sector, or market goes sideways, oscillates back and forth within a range, and that gives time for the 150-day moving average and the 200-day moving average to come within price, where price is oscillating above it and below it. It flattens. All the moving averages start aligning right here, 10, over 20, over 50, over 150, over 200. And this area is precisely where we did try some semiconductors short with SOXS in Turbo. And as you can see, now you have the longer term trend behind your back. And let's just look at the chart over. This is a chart. Maybe if your eye is conditioned at looking at bearish charts, you can see this easily. But for me, at least, since I am primarily a long only trader, not long only, primarily a long trader, inverting the chart just gives me a bit more clarity when I do want to short. a
Yeah,
stock.
look, the easiest
it's just
analogy,
a quick tool.
folks. Look, if you're playing tennis, you play a left-hander. You rarely play left-handers. They're hard to play with because you're not
Exactly.
used to it. You play a right-hander. That's just because you're used to it. So you're used to looking at bullish charts, long charts, because you're trying to buy. You're not trying to short. So you look at those charts much more often. So you're just flipping the short chart
Right.
to make it look like a long chart to see if you want to short or not.
Exactly. And I'll just want to give one more example where it would keep you out of a lot of frustration. If you go on the NASDAQ QQQ weekly chart, I want to showcase this last bull market as well. So I'll first keep the regular chart up. Same thing, we had that 2023, late 2023 pullback. Then we had that summer yen carry trade. And if I invert the chart, it does give a little bit of clarity, and there's a change in character this time around. And I'll get to that real quick in a second. That first 2023 pullback, steeply declining moving averages. 20-week was declining, 30-week was declining, the magenta line, 40-week is declining. We tapped that, rejected, we continued the bull market. Yen carry trade scare. We broke through all key moving averages, and then we pretty much overshot the 40-week. All of these moving averages were declining, and we continued this downtrend, where in the regular chart it would be an uptrend. But this time around, there are some changes in character here.
Slope of the line.
Of course, had a similar, exactly, the slopes of the line. Of course, we had a similar sharp pullback, and people I've seen on social media, even other professionals say, this pullback is just almost as quick as the yen carry trade. Let's start buying the dip. And they've been doing it for multiple weeks in a row, and it hasn't been too favorable so far. And the reason being is that this bull market has lasted about 2 years so far from the lows of 2022. And at this point, we've oscillated enough to where the longer term trend or moving averages has caught up a lot more to price. As you can see, from the highs to the 40-week, this margin right here is a lot smaller than this one from the highs to the 40-week. And that just shows the longer term trend is starting to slow down. And at this point, we have a flattening 40-week moving average to black, flattening 30-week. And here's a big part too. The rising 10 is above a rising 20 now. And although that doesn't signal we're definitely going to head into a longer term uptrend in this chart or a longer term downtrend in this chart, that is a change in character right now, and we are monitoring that very closely. What we don't want to see is the 10 to get below the 30, 40, and then the 20 as well, and have the full bearish alignment like the semiconductors ETF, where you can see the red is below the green, 20, below the purple or magenta, the 30, and below the 40, with all of them declining. And if we go back to the Qs, we don't have that quite yet. So there could still be more frustration. We could run back into these declining moving averages and the flattening moving average, and that will be a critical juncture to see what the markets do then. And so I just want to showcase this shorting trick that I use quite frequently now, especially since we are getting some bearish signs.
Yeah, the market's changed. Shorting is more popular now.
All right, good stuff, Ted. Dan, that's it from the tech side. You can take us on home.
All right, listen, folks. Here's in a nutshell. Look, if the pie charts or us worked so well, this wouldn't be an issue. Edward Jones wouldn't have to shed their cookie cutter image. If the cookie cutter was making money, nobody would care. Everybody want the cookie cutter. I want the cookie cutter. I want to make money. It's not, and then they go down 30, 35% because that diversification story, we call it diversification, is a lie. It does not protect you. Diversification does not work and protect you from a bear market. All the correlations grow together and they all go down together, albeit at different rates. All those pie charts are us, whether they call it target date fund, lifestyles fund, 60-40, or some asset allocation with some arbitrary rebalancing one day a year. Hopefully that's the right day. You got 1 out of 365 chances of being right. You might be 365 of getting it right. All right. Or you could manage risk by price. Price is truth. You could manage risk. You could try to focus on the strongest areas and try to stay away from the weakest areas. And then when it really hits the fan, you just go flat or get out of the way. That's how we do it at Revere. That's how I do it for my money. my family's money. Don does it for his money and his family's money. This is how we do it for our money. If you want your money to look just like our money, when I say just like, I'm talking about when you're fully assimilated down to the timestamp and price. You will actually have the exact same performance as I do, less the management fee, because I don't charge myself a management fee, but I'll charge you and you'll still be happy because you don't have a pie charts or us, and you're not getting slaughtered every 5 years, and you're not making an average 7% average lousy mediocre return. If you want a better way to invest, free of conflicts of interest, and we're in it right there with you, come join the Revere family. Folks, just go to the Revere website, revereasset.com. Up in the right-hand corner, there's a subscribe button. Put your name and email address in there, and this show will go into your inbox Saturday morning. We've recorded every Friday morning, normally Friday in the morning. But Zach will have this podcast out by 1 o'clock Central Time. So if you're a YouTube subscriber and you just go Revere Asset and just hit subscribe, you'll have this before the Friday market close. That's how our stock nerds do it. And then we do a video every night the market is open. We're the most transparent advisor, not in the country, but in the world that I'm aware of. I don't know of any other advisor putting out what they're doing every day. And you can always call us old school at 855 Real Wealth. Folks, we'll talk to you next week on your money, not their money, your money.
It's not how much you make in the market, it's about how much you can keep.